Is the commercial real estate implosion upon us? And how much could apartment buildings drop in value? How much could commercial real estate drop in value? How about industrial? How about retail? How much could office spaces drop in value? Well, we've got a new report, multiple new reports here, but one in particular is going to give you exact percentage forecast for where the pain could be coming in real estate. So, let's get into the topic. Keep in mind, I am a licensed real estate broker, but not only am I a licensed real estate broker, I run an actively managed ETF. I've got courses on building your wealth, especially 0 to millionaire real estate investing courses linked down below. I'm a licensed financial advisor, and I've got a real estate startup, so real estate is absolutely near and dear to me. And because we're sitting on cash at that real estate startup, we're ready to buy sweet, sexy deals in real estate. I'm sharing that journey with you of where we ultimately want to buy and the research that we're studying. So, without further ado, let's get into some of these reports on commercial real estate and where the stress is coming from. Because, well, it's a little bit of a problem. We'll also talk about housing. In fact, before we talk about that, commercial and industrial and stuff, let's do a quick little snippet here on housing and what's driving this sort of segmentation in real estate that we're seeing. Look, we know rates have gone up, real estate rates have gone up, which have made real estate more unaffordable. We know that housing prices have fallen more in the West Coast in areas like Phoenix, in areas like Austin, Boise, Idaho, some of the work from home places. California has been hit, but we also know that parts of the country like Florida have actually been holding up and doing pretty decently. So what's happening here and why are we seeing this divide? Well, according to Bank of America, when it comes to single family housing, one of the reasons we're seeing this divide in the Sun Belt area is the following. Median rents and mortgage payments for all Bank of America customers were up 8% and 7% year over year respectively, but some Sun Belt regions are seeing a bigger surge. In Phoenix, median rent payments grew by 26% year over year, compared to just 2.5% in San Francisco. That's a big deal, especially since home prices in Phoenix are down about 20 to 25%. That's quite interesting. From peak, comparing back to May. According to Bank of America's internal data, mortgage payments show a similar regional divide. So why have some areas experienced a much bigger housing boom than others? And one underlying reason may be complex, but we propose some potential explanations. Domestic migration has been driven by affordability, above average unemployment gains, and an increasing share of higher paid jobs. And so really, they're making this idea that rent payments are potentially growing where the jobs are growing. Okay, well, what a surprise. Well, where are those rents and jobs going? So let's take a look at this. Median rent and mortgage payments based on these various different areas in the United States. So, and we're going to align this with home price declines here as well in just a moment, and I'll show you this. I'm going to pay a specific attention with a green circle to this region right here. Look at this. Rents up 23%, 20% Atlanta, Orlando, Tampa 23%, Miami 16%, Dallas 18%, rent in Austin up 21%, Phoenix rent up 26%, Los Angeles only 6%, and rent in San Francisco only up 2.5%. So why are we potentially seeing this lower region over here blow up? Well, a lot of folks are saying the reason for that blow up is because of jobs. Offices going to Austin, Dallas, new offices going to Miami, Tampa, massive job growth on the right lower side, so the right side of the country in the south, the Sun Belt region, because of an availability of jobs. However, recent studies have shown that only about 3% of jobs in Florida, or I should say Tampa specifically, or 10% of jobs in Florida in aggregate are actually advertising the potential for work from home. So this is creating a really interesting spread where basically work from home drove a boom in many areas, Idaho, Phoenix, Austin, Florida. But that work from home is going away in areas like potentially Austin and Phoenix and Idaho, and staying, and the jobs are going to places like Florida, where that work from home trend is potentially going away. And one of the ways we could see this, before we get into the commercial industry sector, is we can look at median sales prices on the Redfin housing data app. And I want you to show some of the trends. I want you to see some of the trends we're seeing. So these are the trends right now. We can see housing prices slowly starting to pick up at the beginning of the year here. They're not moving flat as we potentially expected they would. They're actually increasing nationwide, which is quite interesting. There's technically negative year over year right now, but not terribly much. But this goes a little bit more extreme when we jump into individual regions. Watch this. Let's go into Phoenix. You're going to see an interesting switch here. Look at Phoenix. In Phoenix, you have a flat level of pricing growth, which means you are actually looking at negative year-over-year pricing, right? Pricing you sat around 468,000 in Phoenix, now down to about 427. Peak to trough, it's even worse. You're looking about 490 to about 427, right? So if you go 490 to 427, you're down about 13%. So maybe not as much as that 20% that had been estimated when we compared to the end of last year. So this is the Phoenix area. Now, look at the area like Austin, Texas. What do you see over here? Austin, Texas, from peak to trough, 439 from 574. Go 439 to 574. You're looking at that about 23% drop. Where are you not seeing these kind of drops? Well, watch this. Go to Miami. Go to Miami, Florida. Look at that. Prices are higher in Florida than they were last year compared to Phoenix, which is negative, or Austin, Texas, which is negative. Let's do another one. Let's look at Tampa. Look at Tampa. Prices are higher this year than where they were last year. So Florida is killing it. So how do we reconcile this housing disaster from a residential point of view, and how then do we compare that to what's going on in the commercial space? And then we'll get some more data as well. So, in my opinion, what's happening is the following. What you're seeing is in work from home areas, you saw a boom and then a big bust. And now, with less companies offering work from home, you're feeling that pain. So you potentially have more price sliding to do in very work from home popular areas, like, for example, an Idaho. Whereas in California, you already had this substantial boom that was accelerated a bit, but that drop is probably less impactful because people are moving to, let's say, Southern California for reasons outside of work. Work and affordability aren't driving migration into California. They might be driving migration out of California for sure, but the net reason people stay is generally outside of the reason of work. And so that might be why you see a little bit less of that bubbliness in California. Whereas now in Florida, you actually see a boom that is continuing. And why is that continuing? Well, potentially because people who are looking for more affordable housing and a more affordable cost of living structure, combined with the opportunity for jobs, are going to Florida. Because Florida is not offering that same kind of work from home as other states were. So you have more of a boom and bust in the work from home states, more stability in California, but more of a boom in California, but more of a boom continuing in Florida. That's what I'm seeing, and I'm seeing the same thing as I travel the country on the ground. Let's look at some more data here, and then we'll look at some commercial stats as well. Take a look at this. This Bank of America piece explains that affordable housing could be what's driving people to these southern cities. Look at the boom that's happening in Atlanta or Florida, for example. Completely agree with that. These markets are still considered affordable, so even more room for markets to increase. Atlanta, Dallas, Tampa. They do have Austin and Phoenix in here, but I just want to put my own asterisk on top of that report because of that work from home potential. Orlando, Miami has become a little less unaffordable already. Then we have more jobs, more income, more housing demand. Absolutely makes sense. And higher paid jobs are creating more of a boom here. Where are those higher paid jobs? Look at this. Total non-farm payrolls, 12-month moving average. Total employment in Tampa and Phoenix was around 7% higher than compared to January of 2020, compared to just 1% for the national payrolls growth. So here you can kind of see some trends of some areas where you're seeing more of a booming employment growth. Just be careful, because some of this I think will change in 2023. So I stand a little bit in contrast to some of the information from Bank of America. Here we've got a Wall Street Journal piece talking about the tale of two housing markets. This is more of what I'm talking about, where look at this, where you could see a little bit more of those increases over here on the right, and potentially more pain in the West, especially Silicon Valley. Silicon Valley, in fairness, is getting hit. Less so in SoCal. More stability here in SoCal for the weather, more pain in Silicon Valley. Here you've got maybe the work from home pain. Here you've got where that Sunbelt boom is happening, with the exception of Austin. Austin is really tech exposed like San Francisco. But then you go to like Dallas, Atlanta, or Atlanta over here, and then Florida. That top one is more like Jacksonville right there. Cities have become closely associated with tech are experiencing the biggest falling of home prices, whereas Florida and southern markets are still attracting individuals. This makes a lot of sense. Many economists expect home prices to fall further on an annual basis this spring or summer. But now a lot of this information, metro areas in the southeast that experience big price run-ups like Nashville or Raleigh are especially vulnerable to price declines. The speculative markets that are not potentially in areas like Florida where jobs are still going. That's very interesting. So big sort of takeaway here so far is Florida looks really desirable, and so does Texas. And that seems to be where a lot of potentially jobs are going. But it really also aligns with what we're seeing over here with what's going on with property prices, and I find this really interesting. This piece from Morgan Stanley, look at this. This piece from Morgan Stanley tells you that property prices could decline or have been, and this is retail, commercial real estate prices. And this, I think, gets affected, by the way, by the boom in work from home, which is hurting a lot of office spaces. But the one place office spaces could potentially still hold up might be Florida, where you're getting less of that work from home. But listen to some of the projections from Morgan Stanley here. Morgan Stanley suggests that property price declines this cycle have averaged 1.32% per month, tracking worse than the great financial crisis. The global financial crisis had less property declines on a monthly basis than what we're seeing now. It's pretty wild for commercial real estate. They expect that office prices will fall 40% in the total 24 months of this cycle, compared to 34% of the global financial crisis. So in other words, bigger declines for offices this cycle, suburban prices falling 40% for offices, apartment buildings to fall 15%, that's less than the 30% fall during the great financial crisis. But they do expect weakness in apartments. Bank of America also talks about office REITs and apartment REITs experiencing more pain potentially than we saw during the great financial crisis. There's also a talk that REITs, especially apartment REITs, are selling at a little bit more of a premium than they otherwise should be. Retail stores potentially a 30% peak to trough decline, industrial a 15% decline. And then overall real estate, including residential real estate, potentially an average 15% peak to trough decline. But I think the biggest and the coolest chart out of all of this to pay attention to is where the pain is happening and where jobs are shifting. And personally, I am very interested in Florida because of the changes that we're seeing. And one of the things that makes me really excited is my opportunity with my real estate startup to basically fly my plane to Florida. And once we're in Florida, we can hop around and explore Florida like crazy. And I grew up in South Florida, so I'm a big fan of the Florida markets. Huge fan, much more than I thought I would be. And the chart's showing us that the Sunbelt regions are booming. We're going to be something we really want to pay attention to. So, with that said, there's a big shift and mix-up happening. I think COVID basically threw all of real estate up in the air, and it's going to be really interesting to see where it all falls. But I'm watching it really closely, and I'm particularly interested in what's going on in Texas, Atlanta, and certain cities in Florida. So stay tuned, follow the channel. I think there are going to be great opportunities. Check out the programs on Building Your Wealth, linked down below. Now we're going to run over to the course member live stream for the bell. Thanks so much, and we'll see you in the next one.